Hello, this is Peter Leahy with the Sovereign Leadership Group module on interest rate swaps. This is the fundamental segment, and this is the fundamental segment on interest rate swaps. This will run as usual for between 15, maybe 16, 17 minutes. There is an accompanying spreadsheet which goes with this, but perhaps that you should look at that. That goes also with the swap cash flows spreadsheet, which is also one of the fundamentals ones, which helps you with a lot of material in terms of actually generating and discounting and valuation to do with interest rate swaps. It should be borne in mind as well here that the whole area of interest rate swaps has been subject to considerable change in recent times. For example, differential discounting and OIS discounting, which are covered elsewhere in these modules, although those are intermediate and advanced modules. So the purpose here is really just to start with some basic ideas on swaps. A swap, an interest rate swap, is a contract where parties agree to exchange future cash flows. An interest rate swap, when we refer to that, is normally an exchange for fixed for floating in the same currency, although there are of course plenty of other possibilities. Some of them are mentioned on this page would perhaps be referred to more as a basis swap. So the cross-currency one mentioned here, floating Japanese yen, exchange for floating US dollars, where both sides are floating payments or varying payments, that's normally referred to as a basis swap. I've also referred to the third of these bullet points, US dollar LIBOR coupons paid and reset quarterly, exchange for US dollar LIBOR coupons paid and reset semi-annually, half-yearly. That as well is a basis swap. The second bullet point there would be called a cross-currency basis swap. The third would be called a tenor basis swap. Our concern, however, in this presentation is mainly to talk about fixed for floating interest rate swaps. Here I've taken off the Bloomberg system an example of an interest rate swap in US dollars. So you can see we've got an exchange of two legs, as we call it. So you can see leg 1 and leg 2, follow my mouse pointer there. You can see these are in US dollars and the notional is 10 million. We say notional in interest rate swaps because the two sides have interest payments. You can think of it as being like a back-to-back loans, where one has a fixed rate of interest payment, 1.734428 in this case, and another one has a varying or floating rate of interest payment. This one's set versus 6-month US dollar LIBOR with no spread, so just 6-month dollar LIBOR, nothing extra above or below that. We say notional because, in fact, while the interest cash flows are particularly important in an interest rate swap, essentially what the swap is all about, because we have the same notion, the same principle, let's say, use that word on both sides, $10 million versus $10 million, we would be exchanging $10 million for $10 million both at the beginning and at the end, were we to do that. And of course, it's entirely rational to exclude that. Therefore, the principle becomes a notional amount, not a real amount. However, the notional remains a very important number because where interest payments, for example, are expressed as percentages, such as the fixed coupon, to calculate how much should be paid, we would of course need to have reference to the amount of notional. We've followed some basic conventions for US dollar swaps. This is semi-annual on the fixed side, and we've actually gone to semi-annual, although that traditionally has not been the most typical convention for the floating side of a US dollar swap. But increasingly it's widely used for counterparty risk reasons that we will discuss in a later module. Importantly, the exchange then of 1.73% paid on a fixed basis for 5 years that run from March 2015 to March 2020, well, when we take account of the principal, were that to exist, it doesn't matter because we would be exchanging, we'd have two offsetting payments. You can see there the discounted value of the fixed side of this swap, and you can see on the floating side that were we to have 6 monthly payments of LIBOR, and given the way the LIBOR forward curve looks right now, we would expect then the cash flows of the floating side, when discounted in the same way, to have in fact the same value. So this swap, in this case, at this moment, at the moment of transacting, has a 0 market value. That's useful as a kind of indication and an illustration. It is not, of course, the most realistic thing, because swaps, like any product, there's one party that provides it and looks to make a margin out of it, and another party that is a user, a consumer, a customer, if you will, and looks then to or expects to be paying a profit margin to somebody else. But we've done this then on the basis of what you might call fair value, so excluding profit margin for anybody at the time of transaction. Of course, it might have 0 market value at the precise moment of transaction, but of course the floating side, the expectations, I used the expression forward LIBORs a short moment ago, the expectations in the forward LIBOR curve will change hour by hour, minute by minute, certainly day by day or week by week. And given that they will change, whereas the fixed side remains fixed, it is entirely to be expected then that the swap will come to have some other value, some value other than 0. So I've now sort of retreated a bit and just shown this as in a kind of simple boxes and arrows diagram. I'm going to take a 5-year swap in US dollars. As with any floating payment series, the first floating payment is set at the moment of transaction, because that is the beginning of the interest accruals period for that floating payment. So it is normal with swaps, as it is with any floating instrument, even, may I say, the payment of interest on a quarterly interest paid deposit account at a bank. If you are earning interest quarterly, you expect to be told at the beginning of the quarter what you are going to be accruing during the quarter, and you expect that interest amount to be paid at the end of the quarter, and so it is with swaps. So we set the first floating payment at the time of transaction. We also set, of course, the fixed payments. They become fixed as from that moment. So I've taken just a little example of a corporate treasurer, perhaps a corporate treasurer having a US dollar loan from a bank and committed to paying quarterly LIBOR in US dollars. We could observe market expectations for LIBOR by looking at LIBOR futures, and we could have some idea of what we might expect to be paying as interest payments on our loan in the future. Perhaps our corporate treasurer is concerned that interest rates will go up in the future more than the market appears to be anticipating, because of the corporate treasurer has a viewpoint on how the economy is looking, and that things may actually, growth may return or increase faster than the market appears to be expecting, and that often leads to a rise in interest rates. And perhaps our corporate treasurer is anticipating a bigger rise in rates than the market is. If that were the case, then the corporate treasurer may well be interested in paying fixed, so locking in a fixed rate and receiving floating. In fact, if they keep their loan as it is, they'll be paying LIBOR, and often what they'll do is they'll keep their loan, they'll leave the loan untouched and transact a swap, so that the swap, when taken together with the loan, actually now reflects better their changed outlook or expectation on interest rates. So this corporate treasurer is paying quarterly LIBOR on the loan. They have now committed to pay fixed and receive quarterly LIBOR, and you can think of the quarterly LIBOR floating payments received on the swap as being an offset for the payments they need to make on the loan, leaving them, of course, then paying fixed on the swap. I've taken here then, just to give an idea of how accessible this kind of information is, I've taken here the LIBOR futures contracts at a particular moment. As you may well know, these are shown as 100 minus the rate, giving a price. So a price of 98.08 implies a rate of 1.92%, and these are for each of these for a 3-month period starting in each of these specified months going into the future. So 90-day euro-dollar futures as described here. Euro-dollar, that of course has nothing whatsoever to do with the currency euro. It's just a traditional description of euros priced using London Interbank LIBOR. So from our corporate treasurer's point of view, I've taken here a picture of how the rate expectations may translate into payment expectations on the loan. What do we expect to be paying over the 5-year period on our loan in terms of the LIBOR payments? And you can see, as is often the case, the curve of those is upward sloping. Some of that, of course, and you'll find more of this in the segment on yield curves, some of that, of course, is just naturally the case. It doesn't always mean that participants in the market actually expect rates to be increasing. It may mean more about the ideas of liquidity preference and perhaps inflation and other risks, and as well as credit risk being built in and priced then to offer more reward for those risks for further period, for the further out we go in time. Our corporate treasurer then perhaps decides to pay fixed on a swap. We'll see. That may well increase, or it will in this case, the immediate interest cost to the company, but with the prospect of a later benefit according to the forward LIBOR curve. So here I've taken the same diagram we had a minute ago, and I've added another line to it, which is the 5-year swap rate. The 5-year swap rate, you can see, in this case, might be a little over 2. It's considerably more than what our treasurer is paying or would otherwise be paying right now. But the prospects are, according to the curve at least, that at a later point the company will receive perhaps an offsetting reward for having suffered an increased cost up front. And you can see here I take the cash flows of a swap, in fact the swap looked at earlier, and you can see this is where this is in fact a receive fixed pay float, this is a receive floating pay fixed swap, exactly as our corporate treasurer would want to do. You can see the floating payments, and this does include principal, just the way Bloomberg does the calculations, doesn't make any difference. The floating payments do increase with time, as the curve we saw would suggest. The fixed payments, of course, do not increase with time. They are fixed, and they are the same throughout the life of the swap. If there's any variance at all in those numbers, it's only because of the slight difference in the exact day count of the time periods. Some of these periods will be 181, some 182, some 183, and so on. Notice that our corporate treasurer, when we look at the net cash flows, and importantly, in fact, at the discounted value of the net cash flows, the corporate treasurer is suffering an outflow in the initial 4 periods, and that is compensated for by inflows for the remaining 6 periods. Those amounts all, of course, in this case, sum to 0. So, as discussed before, an initial cost and the expectation, but no promise, of course, of a future reward. However, now, what if the curve, the forward LIBOR curve, steepens, even without, and this is important, even without any noticeable change in current LIBOR? Well, let's explore that and just have a little conversation about how that might look for our swap. So now the darker blue line is the forward LIBOR we did have, and the red and blue areas were kind of an offset for each other. Now we have a lighter blue line, which is a new steepened forward LIBOR curve that's changed. There's been some kind of economic news or change in views in the market, and perhaps poor news on inflation, and the expectations are that rates will be higher in the future and higher than had previously been estimated, and so there's been a steepening of the forward curve. Importantly, two things. Notice that this has not factored in any significant or noticeable change in very short-term LIBORs, immediate, perhaps 3, 4, 5 or 6 month LIBOR. But do notice as well that we can think of the red zone as now having had a little bit taken out of it compared to what it was before. That, remember, is our corporate treasurer's cost, what represents that. And additionally, we can think of the blue zone as having, well, more than doubled. The total of those areas in a shade of blue are comfortably more than twice what they were. My point here is just to say this swap, from the corporate treasurer's point of view, would now have a considerably improved value from their perspective, and that they would, if so desired, be in a position to take that swap back to the bank with whom they originally transacted and close it out for a gain, because the swap will have, when the present value of the cash flows are calculated again, the swap will no longer have a zero value, it'll have a noticeably positive value from the point of view of the corporate treasurer. I hope this has been interesting and useful for you. I do encourage you to persevere and look at the modules now that go into the cash flows and the valuation of those cash flows on swaps.